Have you ever wondered why, no matter how hard you work, you always seem to be struggling with money? While you're counting pennies, banks are posting record profits. Quarter after quarter, year after year, this isn't a coincidence. And it's not because you're bad with money. There's a system in place, a system that's been working against you since the day you opened your first bank account. Let me show you exactly how it works. Chapter 1, the transaction trap. Every single time you swipe your card, banks make money. It doesn't matter if you're buying coffee or paying rent. They charge merchants a transaction fee, usually 2 to 3% of every purchase. The merchant pays it, sure, but who do you think that cost gets passed on to? You, through higher prices. But that's just the beginning. Overdraft fees, $35 for being $1 short, monthly maintenance fees, $12 just for the privilege of keeping your money in their vault. ATM fees, foreign transaction fees, late payment fees. The average American pays over $300 per year in banking fees alone. Multiply that by 150 million customers. That's $45 billion every year, just in fees. Chapter 2, the inflation secret. But here's where it gets really interesting. This is the part they definitely don't teach you in school. When you deposit money in a bank, you think it just sits there, right? Maybe they lend some of it out, but your money is safe? Wrong. Banks are required to keep only 10% of deposits on hand. That's called the reserve requirement. So when you deposit $1,000, they can legally lend out $9,000. Money they don't actually have. This is called fractional reserve banking, and it's completely legal. So where does that extra $8,000 come from? They create it out of thin air with a few keystrokes on a computer. When banks create this money and lend it out, more money enters circulation. And when there's more money chasing the same amount of goods, what happens? Prices go up. That's inflation. Your dollar today buys less than it did yesterday, and it'll buy even less tomorrow. Over the last 20 years, the dollar has lost 40% of its purchasing power. That $1,000 you saved in 2004, it's worth about $600 in today's money. Your savings are melting away like ice cream in the sun, while you sleep, while you work, every single day. Chapter 3, the interest rate. Scam. Now let's talk about interest rates, because this is where the wealth transfer really happens. You put your money in a savings account. The bank pays you 0.5% interest, maybe 1% if you're lucky. Meanwhile, they take that same money and lend it out as mortgages at 7%, car loans at 8%, credit cards at 22%. Let's do the math. Say you have $10,000 in savings. At 0.5% interest, you make $50 per year before taxes. That same $10,000, when the bank lends it out, generates $700 to $2,200 in interest income for them. From your money, you're giving them your money to invest. They're making 14 to 44 times more profit from it than they're paying you. And you're taking all the risk. If the bank fails, your savings could disappear. Sure, FDIC insurance covers $250,000, but that's cold comfort when your entire financial life is in their hands. Chapter 4, the debt trap. But wait, it gets worse. Banks don't just profit from your savings. They profit even more from your debt. Credit cards are the most profitable product banks offer. They encourage you to spend money you don't have. And they make it so easy. Pre-approved offers, cash-back rewards, travel points. They gamify spending. The average American has $6,500 in credit card debt. At 22% interest, that's $1,430 per year going straight to the bank, just in interest. Not paying down the principal, just interest. Student loans, $1.7 trillion in total debt. Average payment, $393 per month for 10 to 30 years. Mortgages, on a $300,000 home loan at 7% over 30 years, you'll pay $418,000 in interest alone. You literally buy the house twice. Every dollar you pay in interest is a dollar you can't save, can't invest, can't use to build actual wealth. And who collects all those interest payments? Banks. Chapter 5, the system by design. Here's what you need to understand. This system isn't broken. It's not an accident. It's not a glitch. It's working exactly as designed. Banks are the intermediaries between you and your money. They control the flow. They control the rules. And they profit at every single step. You deposit money, they make money. You borrow money, they make money. You transfer money, they make money. You withdraw money, they make money. The system is designed to extract wealth from you and concentrate it at the top. Since 1980, productivity has increased by 65%. But wages? They've only grown 17%. Where did the other 48% go? To corporations, to shareholders, to banks. The wealth gap isn't widening by accident, it's widening by design. The truth, so what can you do about it? First, understand the game. You can't win if you don't know you're playing. Second, minimize your exposure. Reduce fees. Pay off high-interest debt. Don't give banks more of your money than necessary. Third, learn to invest. Your money needs to work for you, not against you. Stocks, real estate, index funds. Build assets that generate income. Because here's the reality, the system isn't going to change. Banks aren't going to suddenly start working in your favor. The only thing you can change is your relationship with money. The game is rigged, but now you know the rules. What you do with that knowledge, that's up to you.